Hey guys, welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins-Hutten. Now, if you're joining live today, you're probably wondering, wow, I thought Rob Gallo, the Director of Investor Relations, was going to be on today. Yes, he was covering for me because I had shoulder surgery, but then he got sick. So, anyways, we are dedicated to be here with you to help you learn the ins and outs of passive investing. And so I wanted to make sure that, we at least had the conversation today about multifamily versus debt fund investing, helping you choose which is right for your portfolio. Now, we're going to pivot a little bit. We're going to make this more of an ask me anything type of presentation. So if you have questions, make sure to drop them in the Q&A box. That way I can track them. But I have preceded our conversation with some high-level questions that I want you as the investor to make sure you think through before you invest into either a multifamily asset or a debt fund asset. Now, if this is your first time joining us live, this is not how we roll with every show. Normally, things look very different, but we are making sure that we're providing immense value to here today. But I just want you to know you're in the right place. If you want to learn how to turn your active income and savings into long-term income and passive wealth, this is where we have all the conversations. Maybe you've tried investing passively before, but couldn't get comfortable making the investment, or you actually invested in a deal before and later discovered, wow, that deal just wasn't right for me. What happened here? Or you are a seasoned investor and you simply want to sharpen your skills. If that is you, you're in the right place. Now, I see some people that are raising their hand. Make sure if you've got a question, we don't have the live Q&A box turned on here, so you're going to have to type your question into the Q&A box, and I will make sure to answer those questions during the show. Now, if this is the first time you and I are meeting, again, my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com. And really what I love doing, my job and what my passion is helping investors like you figure out how to leverage passive investments, most likely in real estate and businesses like express car washes, in order to achieve time freedom and choice freedom. Okay. And that's exactly what I've done for myself. I started off in 2002, living, flipping, and house hacking, then eventually went into active, real estate, scaling larger and larger deals, and then started building my passive portfolio on the side. And it was really that passive portfolio that unlocked those golden handcuffs for me and allowed me to do much more traveling and playing and spending time with family and friends. And if you guys are watching this live and not listening to it on the podcast, you know that I had a very active summer and came out with an injury. So, well, anyways, it allows me to sit here and heal too. And I document this journey in our book, Money for Tomorrow, How to Build and Protect Generational Wealth. But again, all of this, everything that I've done over the past 20 plus years of investing has been to achieve one result. How can I get 100% control and choice on how I spend my time? And I want to help you do that here and throughout this series. Now, this is my invitation to you. Make sure to join our passive investing club. There, you can jump on a one-on-one call with me. We can discuss your investing goals, maybe help you apply the information from today's webinar. All right. You also get exclusive access to our open deals, and you get opportunity to participate in more wonderful resources and webinars like this. Now let's jump into today's topic, right? We were talking about multifamily versus debt fund investing, which is right for your portfolio. Okay, now I don't foresee us getting into financial, legal, or tax advice, but if we do, just know that this webinar is for educational purposes only. Always take any webinar that you see online back to your investment team before making any sort of investment decision. All right, so really, when we're talking about is multifamily investing better for you or debt fund investing, debt fund better for you? If that question were asked in my household with my husband and daughter sitting at the table, they would go, yes, right? You're confused, right? Because that is the question. Both assets could be appropriate for you in your portfolio depending on when you're investing. So The first question that I kind of kick us off with here, what's the true purpose of your next investment? Is it to protect your wealth, generate steady income, achieve significant growth, maybe diversify your holdings? Or if you're maybe selling a business, selling some real estate, is it to, harvest some tax advantages? This question, okay, is one of those questions that kind of hints at that we need an investor thesis, right? What's the next step in your investor thesis? Now, if you're one sitting here wondering, hey, Whitney, I don't know what an investor thesis is, I have a wonderful boot camp episode on our passiveinvesting.com YouTube page. You can go there and it'll show you how to put together an investing plan, or as I often refer to it as investing thesis. But really, this thesis is a holistic plan. When you're looking at your next investment, all you do is you go back and look at your plan and go, what's my next objective for this next investment? Having that sort of clarity helps drive your current financial strategy, right? We need to understand, what that next investment's going to do for you. So maybe you've been a multifamily investor for several years and you're like, wow, I need more cash flow. Well, maybe your next investment is not a multifamily deal, but more cash flow. And we can flip that model on its head. All right. So that leads me to the second question. How does each investment type help you achieve your goal? Right? So if you're say your goal is you need growth and maybe tax benefits, um, and a debt fund, it provides fixed income, short duration, liquidity, limited upside, but strong capital preservation. We don't have alignment. Okay. Whereas a multifamily investment provides equity upside, long-term, growth in wealth, depreciation, so we can, get some tax advantages, but we need to know that it has delayed cash flow. Maybe your goal is actually, I need cash flow and I don't need the growth right now, right? You see how we have to ask these questions of ourselves. And, there are multiple people on this webinar. Each person is going to get a different answer for themselves. Another question, and I kind of group these three together because these are three that I often get from investors when I'm on a phone call. If I'm sitting here looking at two amazing deals, one multifamily, one debt fund deal, first question is, this money that I'm about to invest, do I need access to this capital in the next 12 to 24 months, maybe even 36 months? Okay. If the answer is yes, don't put it in an equity deal. Plain and simple. If you need access to that capital, say you have a kid going to college, or you've got a wedding to fund, or that is your seed money for your next property that you're going to purchase in 2 years. Whatever it is, that money is better off in an investment like a debt fund that provides liquidity and maybe has shorter term commitments attached to it. All right. Question number two. Am I trying to grow wealth with this money, or am I trying to protect what I've already earned? Okay. That kind of circles us back to the very beginning here. What is the actual objective with my next step in investing? Again, if you need growth, equity investments like multifamily could be a good match. If you need more protection of capital, debt, especially in a secured first lien position, could matches really well. Now, a lot of people, I mean, myself included, we love investing in real estate because there is an asset attached to the deal. You have a hard asset. Okay. But again, we're not thinking in the term of do we actually own the asset? We're thinking of like this money that I'm investing. Can I really take the risk of, not seeing a return? Okay. So that we got to get clear on answer number two. Okay. And then number three, once we got the answer to the question of one and two, I encourage you to ask this question of yourself. Do I need predictable income now, or am I okay waiting for income and upside later? Right? If income's a priority, debt funds may take the lead. If you are okay waiting for income growth and want that upside, then multifamily. Okay. Right? That could be a great match, or an equity investment. All right, we just need to know. And this, if you've listened to any of my webinars, I've done our three tiers of investment fortress investing plan. Take a look at that because that, really helps investors understand where they may be overexposed. And we'll talk more about exposure here in a second. But that will help you orient on like whether you need income now, if you need to build out that tier, or if you are okay taking the equity income later, right? This is for me, I I don't expect just one investment to do every job in my portfolio, meaning preserve capital, create cash flow, create equity growth, kick off tax benefits, create diversification. I need to look holistically over my whole portfolio to make sure I have those things in place. All right. Now, risk. Um, I actually am fresh off listening to a ton of webinars by Howard Marks, an amazing investor in his own right, a student of Warren Buffett. We have to understand what's your priority when it comes to risk. Are you okay with risk or do you prioritize stability? Right? Because if you prioritize stability, be honest with yourself. Debt funds are the place to be. If you're okay taking on more risk, then multifamily can be and you want to prioritize upside, multifamily could be a good match. Now, this is not to say there are not risks in investing in debt funds. If you go to my webinar that I did over the good, bad, and ugly of debt funds, I give you a whole framework on how to evaluate debt funds. And we actually look at examples of some debt funds out there in the market that are more risky than I think than some multifamily assets that I'm seeing. Okay, so again, what's your priority? The next part of risk, especially if you're going to go into multifamily, is how does leverage impact the returns? Now, in most multifamily investments, or most real estate investments in general, equity investments, leverage, that means we're going to get a bank loan on the asset. That boosts the equity growth, but it can also amplify risk because you've got somebody, say like you get a loan for 60% of loan to value of the property. That bank, should you have to sell the asset, in a challenging market, the bank gets their return first, right? They're gonna get made whole first, and then equity investors after that. But that is using leverage is an amazing way to boost growth and returns on the asset. Just know that, while it can boost returns, it can also cut the other way. Now, debt funds, most people think, oh, debt funds, they don't have leverage. We're good. Okay. Typically, there's no direct leverage within a debt fund. Okay. Within a debt fund, whatever assets are in there, like for our PIC real estate debt fund, we do fix and flip, first position liens on, like I said, fix and flip real estate. That loan collateral is the asset in the debt fund. Now, some competitors in the market do use leverage. They will go get a bank line of credit in order to juice the returns on the debt fund. Okay, so don't just think please don't think just because it says that it's a debt fund that there's not possibly leverage within the fund juicing the returns. Okay, so just know that. How does leverage impact risk and return here? All right, another question. And guys, I encourage you to drop your questions in there. I see one that may have come in. If I had 200K to invest, am I diversified across income growth, preservation, assets, or am I overexposed to a particular strategy? So if you're looking to go into your next deal, ask yourself this question. Maybe it's 100K that you have to invest or 500K that you have to invest. Okay. This is where I think in terms of tiers. One, do I have my liquidity and reserves in place? Okay. Two, do I have a cash flowing tier working for me? Tier two. That's where I love putting my debt fund investments. They're kicking off cash flow. They're helping me, like if all of my equity investments stop paying, my tier two assets are covering all the bills. Okay, that's what keeps me financially free. And then tier 3 is my growth. All right, that's where I'm playing to preserve, get a little cash flow if I can, get some equity upside, as well as harvest some tax benefits. Now, here's the thing, evaluate your portfolio. All right. If you are a staunch multifamily investor and you're just chomping at the bit to get into your 20th multifamily deal, take a look at your portfolio and make sure that you're not already overweighted. All right. All right. Now I put tax benefits for last. How important are tax benefits in this decision between multifamily versus debt fund investing? And the reason is I think uh, while tax benefits can create amazing velocity within your portfolio, meaning you get to keep more income in order to reinvest and grow faster, it is almost like the tax tail wagging the dog. We don't want to do that. So, but if everything, all those other questions above check out, you've got a clear path here and you're just still tied between the two, then ask the question like, how important are tax benefits into my, for my next investment? Multifamily offers depreciation and can throw off passive losses, and it can offset other passive income in your portfolio. And if you're a real estate professional, you might be able to offset some active income in your portfolio. I always encourage everybody partner with your CPA to come up with a tax strategy. Don't try to craft this on your own. Whereas a debt fund investment, the interest income is taxed generally at ordinary tax rates, unless you have it invested in through some sort of tax advantage vehicle like a retirement account. Okay. All right. Now, I want to make sure we leave time for the Ask Me Anything part of the show, but I wanted to walk through these 10 questions to help you, when you're looking at two different investments, multifamily versus debt fund, how do I discern between the two? Here's, some questions that you can ask yourself to start teasing apart, like, which investment belongs in your portfolio right now. Okay. And again, it's not about is multifamily better versus debt fund. It's all about what's right for you, what's right for the timing in the market, and what do you actually need from your next investment. Now, if you've worked through these questions, I bet you kind of fall in one of these three categories. One, you're like, I'm all in on multifamily. I'm ready for it. Okay. You want the appreciation, the tax benefits. You're okay waiting for the cash flow. And you have the ability to ride out the market wave. Why? Because you have your liquidity in place. You have your reserves already built, and maybe you already have that cash flowing tier working for you. All right. And then maybe you just use those debt funds and that cash flowing tier to stay liquid and diversified. Or maybe you fall into our balanced hybrid investor. This is where I would put myself. I need steady cash flow right now, but I also want long-term growth. So I'm going to build my cash flowing debt fund tier. And because I don't need the cash flow right now, I'm going to harvest that cash flow and I'll reposition that cash flow into equity deals when the timing is right. Or you might fall into more on the cash flow focused investor. Okay, you're focused on preservation, you're focused on cash flow. Okay, you're thinking in terms of stability, income, and protecting what you've already built. Okay, you understand that compounding of fixed income within a debt fund can be just as powerful as equity, especially as you're nearing retirement. Okay, here's the thing, every single one of these investors is right. Which one are you? Now, I thank you so much for joining me today, taking the time out of your day, not only to be here with me, but to invest in yourself. If you want to connect with me, if you want to learn more, make sure to join our passive investing club. There you can get access to a one-on-one call with me. We can walk through everything that we just discussed in this webinar. You can get priority access to our open deals and access to additional educational materials. If you're here live, don't go anywhere.